Hi guys, I hope you people are doing well. So welcome to the session. We are going to start off with the performance management revision. We did the performance management revision in the last class also, and now we are going to continue further and we're going to take things forward now. So in our last session, what I did was I actually went through the area of, I actually went through the area of the activity-based costing. So I discussed about the activity-based costing. I'm going to move forward now and I'm going to talk about the other areas of the syllabus. So the first area that I'm actually going to be talking about. So let's have a quick revision of the target costing. What is it? Let's have a quick revision of the target costing. If I talk about the target costing, let me just explain to you a few things that what is this target costing all about. So generally, if we could just quickly recall the target costing, the end of the target costing, what happens is that all that you have to do is that you have to establish the selling price of the product that you are selling. So the selling price of the product is established. From the selling price, what we do is that we deduct the desired margin. We deduct the desired margin. And we deduct the desired margin, resultingly what happens is that we end up getting the target cost. From the target cost, what we do is that we compare the target cost with the actual cost. And when the actual cost is compared, so what happens is that there is actually something called cost gap. There's something called cost gap. The cost gap is established. The cost gap is established. Now, if I could just explain to you about this cost gap, the cost gap is something that you have to close. I repeat, the cost gap is something that you have to close. And what exactly do you mean by the cost gap to be closed? So just try to understand that what do you mean by cost gap to be closed? So when we talk about the cost gap to be closed, this actually means that we would focus upon the labor cost reduction, we would focus upon the material cost reduction, we would talk about the reduction of other overheads, etc., etc., etc. And there are different approaches to reduction of all this. For example, labor. So the labor cost could be reduced by basically hiring the skilled labor, or maybe by imparting training on them. The material cost could be reduced by bulk buying. So the next one of them is basically by other overheads. So all of this could actually be reduced. So what could happen is that you could try to eliminate the cost gap using all this. So whenever we talk about the target costing, this is the approach that we adopt with respect to target costing. What I'm actually going to do is that I'm going to do some questions on the target costing so that you could have an idea that, okay, how is the target costing implemented or applicable within any organization? So let's just try to do some questions on target costing. Okay, this is question number 43. If you could just give a try to question number 43. Okay. So basically, with respect to this, it says match the stages required to the correct step number to describe the sequence used when operating target costing. So this is step number 1. This is step number 2. Step 3. Step 4. Now what actually happens is that with respect to this use function and value analysis. Now when you talk about functional and value analysis, what do you mean by this? This functional analysis actually means that you're getting into the details of the breakdown of how the cost of the product goes about. So that's what you're trying to do. Now, can you give it this one a try? Question number 46. Can you try to do question number 46? Okay, now it says a company has target markup of 25% and sells into a competitive market where the market price is $120 per unit. The company's current cost per unit are $46 for variable cost and $60 for fixed cost, and it has a budgeted output of 10,000 units. What is the minimum production required to close the target cost gap? Now see, just try to understand this thing. It says company's target markup is 25% and it sells into competitive market where the market price is 120 per unit and the current cost is 46 for variable and 60 for fixed cost. It has a budgeted output of 10,000 unit. Now just try to understand this thing. You would say contribution per unit. Contribution per unit is 120 minus 46. So when you say 120 minus 46, it is gonna be 74. It is gonna be 74, right? This. Okay, now see, what happens is that you have got contribution per unit of 74. Now what actually happens is that um, the company has a target markup of 25%. You have a target markup of 25%. See now, what actually happens is that contribution per unit is 74. The fixed cost is $60 fixed cost. Uh, and budgeted output is 10,000 units. So 60 into 10,000 gives you $600,000 as a budgeted fixed cost. Sales, cost, profit. So you want your cost to be, your profit to be 25%. The selling price is gonna be 125%. So actually selling price minus variable cost gives you contribution minus fixed cost gives you profit. They're asking you how many units to be sold. Let's just give it a try. So we know this thing that sales is 125%, cost is 100%, profit is 25%. Now what do we need to do? We need to establish from this that what exactly is gonna be our target cost. What exactly is gonna be our target cost? Now, first of all, how would you do it? You would actually say that selling price right now is 120. So how much should be the cost? So you would say 120 divided by 125 multiply by 100. So 96 should be your target cost. Less variable cost, less variable cost, which is 46. So the fixed cost that we can have is basically 50. Fixed cost that we can have is 50. So basically what happens is that in order to establish the number of units, see 600,000 is the total fixed cost. And this total fixed cost is units multiplied by 50. So units is gonna be 600,000 divided by 50. So gives you 12,000 units. So your correct answer should be 12,000 units. I repeat, your correct answer should be 12,000 units. Let's move a bit forward. Let's discuss further. Okay, here you have got question number 54. Can you give it a try, please? Question number 54. Okay, it says the selling price of product X is set at 550 per unit and sales for the coming year are expected to be 800 units. A return of 30% on the investment of 500,000 in products X will be required in the coming year. What is the target cost for each unit of product X to two decimal places? So you know this thing that the selling price is 550. Uh, Plus what happens is that a return of 30% of the investment of 500,000 will be required in the coming year. So this return is going to be 500,000 multiplied by 30%. 500,000 multiplied by 30% gives you 150,000. How much is it? It gives you 150,000. So 500,000 multiplied by 30% gives you 150,000. Now, uh, so what happens is that we need to earn 150,000. So if I say 150,000 is the target profit, so 150,000 divided by 800, which is the number of units. This actually gives you 187.5 as the target profit per unit. So the balancing figure is gonna be the variable cost. 362.5. 362.5. That is what it is going to be. 362.5. Okay, let's move a bit forward and let's do some case study questions, case OTQs. Okay, this is question number, this question named as Daras Company. So can you just read through the question, Daras Company? Yeah, can you just read through this area? email कर दी. Okay, let's just start off. It says Daras company. Now what happens is that Daras company is a global consumer. Is a global consumer electronic manufacturer. It sells its own brand of smartphones, computers, and personal entertainment devices. It uses target cost. The board of Daras company has conducted a feasibility study in order to decide whether or not to launch a new device. The D-pad. In 2009, the D-pad will have a 3-year life cycle over which a total of 80 million units will be sold. 80 million units you are going to be selling over a period of next 3 years. The variable manufacturing and selling cost of the D-pad is currently estimated at 123 per unit. The total fixed product cost, including investment and overhead, is budgeted to be this over the whole life cycle. The initial estimate of selling price included in the feasibility study for D-pad was calculated to ensure a profit markup of 60%. So when I talk about a markup of 60%, so what actually happens is that the total cost is variable cost $80 into 123 gives you 9840 million. Gives you 13,200. Gives you 13,200. Now, so what are we trying to estimate? Sales cost profit. This is actually so selling price is gonna be divided by so $264 is gonna be the selling price. $264 is gonna be the selling price. तो ये तुम जा रहे जाओ अगर हम आ गया आ जाए फिर जाना. Okay, now market research analysis. Board decided to commission market research and to determine the price the customers would be willing to pay for D-pad. Sales volume and sale prices were estimated for the various stages of D-pad's product life cycle are as follows. So introduction phase, the growth phase, the maturity phase, the decline phase. Okay. So now it says based on market analysis, board has approved the development of D-pad as long as total product cost, including does not exceed $13,000 million. It's 13,200 million right now. That's what the target is. With respect to retail outlets, that's what now it says. The board of Darask is also considering the opening of some retail outlets which will be located in major cities around the world. The outlets, as well as selling Darask company's products, will hold free of charge surgeries where the product users can seek help on how to use their devices and have their devices repaired. The board has been discussing whether it is possible to use target costing in relation to the retail outlets. The following statements have been made. Director X, Director Y, Director Z. With respect to Director X, he says target costing cannot be used because it is difficult to estimate selling price, so and so, so on. Now, Which of the following statements about target costing at Daras is correct? It relies on GIT in order to work. No. It can be used along with life cycle costing and planning. It can be used. Not necessary to use. What was the initial selling price of DPAD from the feasibility study results? So we already did the calculation and it was 264. It says based on market research analysis, what is the total cost gap of the DPAD if Daras wants to achieve a target profit margin of 45%? So you want to achieve a profit margin of 45%. How would you do that? 264 multiplied by, we established the total sale that was 21,120. The sales was 21,120. The cost, margin at 45%. 9504. The actual cost is 13,200, which we already calculated. 1584 is the cost gap. Now, based on what is the total cost gap if Daras wants to achieve a target profit margin of 45%? Unable to see any of the answers in this. Anyways, can you do 90 and can you suggest what could be the answer for 90?